It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader today. This video newsletter is brought to you by PortfolioCrafter.com.
Welcome to this edition of the TradingTips.com video newsletter. In this episode, we'll be looking at range bar charts, an entirely different way to look at the market. Without further ado, let's begin. Now, most technical indicators and charting systems were developed decades ago, perhaps as much as 100 years ago or more. But this isn't the case with range bar charts. They were developed by a Brazilian trader named Vicente Nicolellis in the mid-1990s. Range bar charts are designed to allow traders to make use of volatility. They do this by eliminating time as a factor. Vicente Nicolellis ran a trading desk in Sao Paulo, Brazil, where markets were extremely volatile. After years of research and backtesting, he developed the range bar idea, which deals with price only, not with time. Instead of a new bar being made every minute or second or hour or day, range bars occur only when a stock reaches a new price plateau. There could be several bars within 1 minute or none within an entire day. The idea is that there will be more range bars when volatility is greater and fewer range bars when volatility is light. More action equals more bars equals more opportunity for profits. Here are the rules for range bars. 1. Each range bar must have a high-low range that equals the specified range. 2. Each range bar must open outside the high-low range of the previous bar. And 3. Each range bar must close at either its high or low. Here's an example of two range bar charts. The top chart is for Google, ticker GOOG. The bottom chart is for Research in Motion, ticker RIMM. Both show a day's worth of trading, and both have the predefined range of 10 cents. That means every time the stock breaks to a new 10-cent barrier, a new bar is created. Notice how there are many more bars on Google's charts than RIM's, even though the chart considers the same amount of time. That's because Google is a higher priced stock, so it is probably not appropriate to use the same predefined range as you'd for Google as you'd use for Research in Motion. How do you know what settings to use to make the most useful charts? In general, higher priced stocks should have bigger thresholds, but the predefined ranges should also take the stock's average volatility into account too. The best way to determine what range to use is to consider the stock's average true range, or ATR. We covered average true range on a previous TradingTips.com episode, and you can brush up on that indicator by searching for average true range at TradingTips.com. Once ATR is determined, you can set your predefined range based on a percentage of ATR. The percentage you use should be based on your trading goals and time horizon. The smaller the range, the more bars. This is good for short-term trades. For longer-term trades, use a bigger predefined range for more meaningful but fewer total bars. Once you've determined an appropriate range, range bar charts work just like any other chart, only better, at least in the opinion of their devotees. The idea is that time adds noise and confusion, with insignificant trades clouding things. Range bar charts make bars when the trading is good, and they can be analyzed just like any other chart. Range bar chart fans will say that support and resistance on a range bar chart, for example, is much more significant than support and resistance on a regular time delineated chart. Here's an example of a range bar chart where the bars form a channel with support and resistance, and then the stock breaks out to huge gains on the upside. And here's another example of a range bar chart where a channel is formed, this time a descending channel. But once again, the stock breaks through the upper trend line and goes on to huge gains. Remember, time is not a factor on this chart. The bars on this chart were formed by the stock exceeding or falling below its predefined range. Refer back to earlier in the video for the rules for range bar charts. Another way to use range bar charts is as a simple measure of volatility. Instead of looking for patterns, the number of bars itself can be an indicator. More bars equals greater volatility, fewer bars equals less volatility. In conclusion, range bar charts do not consider time. Time is irrelevant. Range bars are added to charts whenever a price threshold is exceeded, either to the upside or the downside. This means that more bars are printed when volatility is greater, fewer bars are printed when volatility is lower. Believers in the range bar system say this makes range bar charts more significant than standard charts, as range bar charts eliminate excess noise. You can use range bar charts to find patterns in chart formations just as standard charts, or you can use them as a simple measure of volatility. We hope you've enjoyed this TradingTips.com video newsletter. Thank you for watching and good trading.
This video newsletter has been brought to you by Portfolio Crafter. Manny Backus designed Portfolio Crafter to be one of the easiest trading systems available on the web today. But don't take our word for it. Visit www.portfoliocrafter.com and access the free special report. It will show you how you can place profit-rich stock trades in just 15 minutes a week. Read the free report, and you'll understand how the easy money's made in the markets. To access the free report, visit portfoliocrafter.com. Portfolio Crafter, another market-beating investment service from WealthPire. Take control of your financial destiny. View more Trading Tips videos. Visit tradingtips.com. Sign up for our free video newsletters and become a successful trader today.